Have you heard of whales? The saying, big fish eat little fish. No, I'm not talking about the giant animals in the sea. Well, did you realize you were the little fish? You look at the stock market app on your phone. You see a stock suddenly drop 10% or rise with inexplicable volume. There's no good or bad news about the stock. You look at the balance sheet. Nothing has changed. There's no event to explain the movement in the stock. But what if this movement was planned months in advance? In the financial world, the giants who plan, fund, and direct this movement are called whales. But they're not just players with big money. They are the actors who manage liquidity, delay price discovery, and often create and leave behind the movements you perceive as opportunities. Today, we will discuss the unseen side of the market, the system hidden beneath the surface, dark pools, algorithms, and manipulations. The stock market is not the same for everyone. The market you see does not operate on the same level as the market where whales trade. Public exchanges are where prices and orders are visible. However, this visibility is a risk for big players. Imagine a fund selling millions of shares. If it did this on a market visible to everyone, the price would plummet before the sale was even complete. That's why dark pools exist. Dark pools are private platforms where large institutional investors execute their trades anonymously without reporting them to public exchanges. In these pools, the order book is invisible, the order size is unknown, and the price is not disclosed until the trade is executed. Trades are often executed at the exact midpoint between the bid and ask prices. This is called midpoint execution. So the whale moves deep down, but you only notice the water rippling after it's too late. More importantly, many brokerage firms match customer orders within their own systems without ever sending them to the exchange. This is called internalization. You think you're placing an order on the market, but the order may never have been sent at all. Meanwhile, real supply and demand continue to take shape somewhere invisible on your screen. Let's return to the question we asked earlier. Why did the price move when there was no news? Because the movement happened before you looked. It just appeared late to you. Dark pools are where whales execute their trades. Whales do not move the market with a single large order. On the contrary, they divide the movement into parts. A whale's desired buy or sell position is rarely entered as a single order. The order is divided into thousands of small pieces. It is spread out over minutes, hours, or even days. This is called order slicing. This situation can be likened to slowly dropping a massive ice block into a water tank in small pieces rather than dropping it all at once. If you drop the ice block as a whole, you create a big splash and overflow. However, if you drop it in small pieces, the water level rises without anyone noticing and without causing a major disturbance. This process is managed by AI-powered algorithms. VWAP, or volume-weighted average price algorithms, spread trades across the average volume during the day. The goal is to make the price appear as normal as possible. TWAP, or time-weighted average price, is based on time. It distributes the trade evenly across a specific time interval. Some tactics are not strategy, but manipulation. In a method called spoofing, large buy or sell orders are entered into the market. The purpose of these orders is not to execute a trade. The goal is to create the perception that there is demand or supply. The investor sees this signal and takes a position. The order is then canceled before the trade is executed. You can think of this situation as a fraudulent auction. Imagine you want to sell your antique, but think the price is lower than you want. Among the participants, there's a friend of yours who has no intention of buying, but keeps raising the price. When real buyers see this high interest, they panic, thinking the product is very valuable and the price will rise even further and start bidding higher. Just as your friend is about to buy the product, they make up an excuse and withdraw their bid. As a result, the product sells for more than it should because the fake buyer drove the price above the antique's true value. The fake participant here is a spoof order in the market. Its purpose is not to buy the item, but to force others to raise the price. This method is illegal, but it is also difficult to detect. So far, we've seen how whales operate, but it's not the short-term traders who really shape the market. The real power lies with those who don't sell. The Big Three: BlackRock, Vanguard, State Street. These three are the largest shareholders in approximately 88% of S&P 500 companies. This represents not only the size of their investment, but also their say in these companies. In short, the votes of these three companies carry significant weight in the decisions made by corporate boards. These companies are not traders. They are not concerned with daily price movements. Rather than buying and selling shares, they have the right to express their views on the company's management. For example, BlackRock made its investments before 2025 and did not interfere much in their management. But with 2025, it reviewed its demand from the management of the companies it invested in. It stated that it wanted not just promises, but concrete, measurable long-term strategies. Vanguard, on the other hand, announced that it now prioritizes cognitive diversity and strategic competence in its boards of directors, not just visible diversity. In summary, the Big Three are not just the biggest whales in the financial ocean, but a major part of the ecosystem that determines the water temperature and the direction of the current. This is a natural consequence of today's financial order. Now let's turn to the darker side of the business: manipulators and finfluencers. Finfluencers are individuals who gather a following on social media, claiming they don't give investment advice, but essentially do exactly that. Manipulators typically choose altcoins, meme coins, or penny stocks with low market value and weak trading volume because it is much easier to control the price of these assets with little capital. The first step is to accumulate a large amount of assets without affecting the price. The next step is promotion. They advertise the stock, particularly on platforms like X, Telegram, Discord, and WhatsApp, through influencers, directing crowds toward the asset with narratives of rising prices and opportunities no one else knows about. They even create FOMO, fear of missing out, by using AI images of well-known individuals or images of people who have purchased the asset or made a profit. With this hype, the demand for the asset from novice investors causes prices to rise, and the manipulator quickly sells their shares and disappears. The asset price falls rapidly. This mechanism is called pump and dump. In the US, the SEC charged 8 individuals in 2022 for allegedly orchestrating a $100 million scam by directing investors through social media. The US market is one of the world's largest markets. Now consider the potential for pump and dump manipulations in smaller countries' markets. There's a common conclusion to everything I have explained so far. When small investors see price changes, they often miss the reason behind them. Dark pool transactions are reflected in the bands with a delay, and algorithmic transactions are completed without leaving a trace. You see the movement on the chart, but the reason for that movement is already in the past. Of course, some tools can partially analyze this movement. Liquidity heat maps, volume concentrations, abnormal order behavior, and so on. These won't catch the whale, but they'll make you feel its approach. The truth is, information asymmetry never fully disappears, but awareness prevents you from playing the wrong game. And sometimes, not losing is more important than winning. Despite all these structural inequalities, the market is not a completely closed system. From time to time, the collective behavior of individual investors can truly change the game. At the beginning of 2021, GameStop went beyond being just the stock code of a video game store. It became a symbol of the collective power of individual investors in global financial history. This event proved that the financial world is no longer just a game played behind closed doors by the elite, but that anyone can have a seat at the table thanks to the power of social media. Thousands of small investors who united on Reddit's Wall Street Bets forum created a volume capable of standing up to massive hedge funds. This was a giant step toward the democratization of finance. Another aspect of the incident was the market's resilience in the face of this tremendous shock. While stocks were causing turmoil on public exchanges, dark pools allowed institutional players to manage their massive positions without completely collapsing the market. The GameStop incident spurred market regulators like the SEC into action for a more transparent market structure. Small investors now use advanced tools like Bookmap to analyze market data and identify institutional tactics. In summary, the GameStop incident proved that small investors can come together and change market dynamics. This situation is the first major victory of a new and more equitable financial world where individual intelligence, social media interaction, and the pursuit of transparency converge. It is not an end, but a beginning. In the next video, we will once again lift the mysterious veil of the financial world. Take care. See you soon.